All right, so welcome to the risk management video part number 2. In this video, we're going to be going over a few more advanced topics. I decided to make this section completely separate because with the information you know from part 1, you can trade intelligently and do very, very well. This section, though, is going to go over margin trading. It's also going to go over some advanced stop loss strategies and a few other things. And it's not a recommendation to do the things that I talk about here, but it will give you the information that you need so that you could choose to use this if you want to. So here's what we're going to be covering in this video. First is going to be a quick summary of what we learned in part 1. Then we're going to go over the Cryptolite position sizing calculator. This is available for you in the course and also in the Cryptolite VIP. We're also going to be going over trading journals. I'm going to be sharing with you the trading journals that I personally use. Then we're going to be going over margin trading and trading with leverage. This is a really, really intricate topic that a lot of people get wrong. In my opinion, they need coaching on this and they probably should stay away, but I'm going to teach you how you can actually margin trade without putting on extensive risk to your portfolio. In fact, I'll show you how to put on margin trades so that you don't even put any extra risk onto your portfolio, yet you'll be able to actually increase your profits. So that is a very, very cool thing that I learned, and you will understand this when we go over the margin trading section. Then once we do that, we're going to be going over a lot of examples. This is key. This is what you're getting in this course right now. This is what really makes this course. It's the fact that I provide a lot of examples so that you could see exactly how I do things. And then we'll go over some advanced stop loss strategies and then finally some final words. So just to reiterate what we covered in part 1, we covered counterparty risk, which is the risk of holding your money or cryptocurrencies on exchanges and also participating in sketchy things. Then we went over your trading portfolio. This is the size of your account, and you need to know this at all times. And we also went over all of these other things that you can now pause this video and reread. And so what we'll do is we will go over the basic stuff, and then we will implement that into the Cryptolite position sizing calculator, and I will show you how that works and how to actually do it step by step. And then we will go over the trading journals. And then once we do that, we could go over margin trading and how I margin trade, and we'll go over examples with that. So let's get started. Okay, let's start off by creating an easy example using the information that you should already know. Let's say that your trading account has $25,000 in it. This is your trading portfolio balance. Okay, so you know your trading portfolio, you know what that is. It's $25,000. Now let's say that you are in 0 trades and you want to put on a trade. Well, let's go put on a trade so that we could then calculate all of the other things that we have here. Okay, so let's start off here and say that you see this happen. You see that there's some gigantic candle move up, some consolidation, and then another couple candles up with huge, huge wicks. So you think that the price will come back down. And so what you do is, let's say, for example, you take the Fibonacci from the bottom to the top and you say that 61.8 is right here at 0.9515. So you think to yourself, okay, I'm going to get in right above the 61.8. I'm going to get in right about here. And I will want to get out, let's just say right here. Not only is it the 38.2, but there's also this, resistance or this level of confluence, you could call it right here, right? So I'll just put that as red. And so you want to get in here and you want to get out here as your take profit, which is about 18.53%. Really good take profit. And your stop loss will be right underneath the golden pocket zone, which is between, the 61.8 and 65% of the Fibonacci retrace. So your stop loss is 4.84% below your entry, and it is at 0.9147. So this is the trade that you want to put on. You have this down in TradingView. What do you do now? Well, if we go back here, you can see that the first thing we need to do is to calculate the position size. So to calculate your position size, if you remember from video 1, we went over the calculations and we did the calculations on a calculator. And I did say that there were calculators available for you online. And I also mentioned that in the VIP of the Crypto Elite VIP Discord group, there is a trading calculator for you available for free. So what you can do is you could go into the Crypto Elite VIP. If you are a member, you could go under Read Me First VIP Welcome. And underneath that, you will see VIP resources. And in this channel, if you scroll all the way to the very top, the very first thing that I have is the Crypto Elite Position Sizing Calculator, Non-Leverage and Leverage. And this is the position sizing calculator I use for my trades. It's in the Numbers software for Mac. And then I also uploaded it a little bit further down, position sizing calculator in XLSX format for non-Mac users. I am on a Mac. So what you do is you click whichever one you need. And so I will click this. And when I download it, this is what will come up. This is the Crypto Elite Position Sizing Calculator. And let's just go over this right now. Right here, you have the account size. This is where you put in your total portfolio or your total trading portfolio account size right here. Then you have your total portfolio risk. This is where you put in the amount of risk that you want to be putting on to the trade. Then you have your total portfolio risk in dollar value. This, you do not input anything into here. You only input things into the yellow brackets, okay? This is the only thing that you put actually put things into, is where it's yellow. You don't have to put anything into the white areas, and the blue area is what will generate for you. That's your position size. So basically, you put your account size in here, and for this example, remember we were using 25,000, so I'll just put $25,000 right there. That's the account size. And then the total portfolio risk, that will be, let's just say 3%. Remember, that could be anywhere between 1% and 3%. And then if you feel very, very confident about a trade, like extremely stupid confident about a trade, you could up it up to 5. That's at least what I do. We'll keep 3% right here. Leverage is 1, like we're not using any leverage. So you could just keep this at 1 here, right? Margin required. This is all for margin. We'll go over this in a few minutes. Number of shares, you don't really have to pay attention to that. Recommended position size. So this is what will pop up when you input the information from TradingView from your trade into this calculator. So let's go back into TradingView, figure out these numbers, and then input them here. Okay, so we're back into TradingView, and this is what you see. You see that your entry price is 0.9612. So 96.12 is your entry price. Your stop loss is 4.8% below your entry, and your stop loss price is 0.9147. So it's 0.9147. That's your stop loss price. It's in red. Your take profit price is right here in green. It's at 1.1393. So 1.1393. That is your take profit price. So what you need to do is input each of these things into the position sizing calculator. So I'm going to go do that right now. And there you go. Right here, you could see we have the entry price of 0.9612, the stop loss price of 0.9147, and the target price of 1.1393. So what is this saying? It says that the RR ratio is 3.83. Is that good? Yes. It should be over 1. Is it over 1? Yes, that is true. It is. So let's go back in TradingView and check that real quick. In TradingView right here, it says the risk to reward ratio is 3.83. Let's go back to the position sizing calculator and double check. 3.83. So you could see that the RR is really, really, really good. Okay. You could also see that the return on trade is 18.53%. And if you win this trade, then you will return 11.5% on your account. You'll grow your account by 11.5%, which is freaking amazing. So the return on this trade is 18.53. Let's check TradingView real quick. You could see 18.53 right there. So that's your take profit. That's really good. And so when you input the entry price, the stop loss price, and the target price, This right here, recommended position size, auto populates $15,503.23. This is based on putting on this particular trade using or risking 3% of your account. So this particular trade risks 3% of your account. So if you put $15,503.23 into this trade with an account size of $25,000, if it hits this stop loss right here, if it hits it, then you will lose 3% of your account. And remember, you want to bet 1 to 3% of your account on every single trade, unless you are just extremely confident in the trade. Then you can bet up to 5%, or at least that's what I do. And if you're not confident in the trade, if you're very unconfident in the trade, then you could either just not trade it, which is probably what you should do, or you could trade less than 1% if you want. So you have enough money for this trade. So this is how it is done. And then what you do is you can go right here and you could type in this trade, which is for, I believe, BAT. So you can type in BAT USD. Risk per trade, you're risking 3% on this trade. And then if we go back into TradingView, what I like to do is I like to click publish idea, and then I will type in BAT right here, and I'll just click whatever trend analysis, and I'll tag it as BAT, and then I'll publish it, and then I will copy this right here. I will copy this, right? And then I'll go back into here and I will highlight this right here, and I will add a link, and I'll add a web page, and I will add that web page to it, and I'll just click enter, and then I'll just click off of that. Now, when I click on it, it opens that thing that I just put on, right? So that's how I do it. And that way I could press the play button and see how it plays out. Okay, so now at this point, you created the trade in TradingView. You know what you want to actually trade. You went into the trading calculator and you actually got the correct position size that you should put your, into your trade. And then just for fun, we could see how this actually played out. Price came down. Price came down here. We entered in right here. The price came all the way up, but we did not exit our trade. We held steady and we held it and we held it and we held it. And we almost got wicked out down there, or stopped out down there. But the price ended up doing something crazy like this, and we ended up getting out right here. And so, yeah, we have our trading portfolio. We have calculated our position size. We calculated the lot size, although that doesn't really matter. And we also calculated our risk per trade. We determined that we want to risk 3% for this trade. We have our stop loss set. We had the risk to reward ratio. It was about 3.8. Actually, we know what it was right here. It was 3.83. That was the risk to reward ratio. It was over 1, so that was good. And we used the Crypto Elite position sizing calculator. And right here, this total portfolio risk and available risk, go back into the previous video to go back over this, but I'm going to show you how the Crypto Elite position sizing calculator calculates this for you. Okay, so let's say that you have the BAT trade on and you are risking 3% on that trade. Now let's say that you are looking at the market and you see more trades that you want to put on. Well, as you put on more trades, you really have to keep in mind the total risk that you are putting on your portfolio. So normally professional traders only want to risk about 8% of their entire portfolio. When it comes to crypto traders, they don't really trade. Most crypto traders are just pretending, and they aren't real traders. They just go YOLO or balls to the walls, or they, risk everything and gladly go to zero. And it's like zero or hero mentality. But this is about trading seriously. So for me personally, in my trading account, I will most of the time risk 10%, and I'll cap my total portfolio risk to 10%. So if all of my trades go against me, then I will lose 10% or around 10% of my portfolio. because, I use the stop loss timeouts. So sometimes the price dips and I could lose a little bit more. So if I set it at 10% and let's say all the prices go down and they go down, a couple percent more than my stop loss price because I use the stop loss timeouts, then maybe I'll lose, somewhere between 10 and 12 or maybe 10 and 15, but usually like between 10, 11, 12%. And that's what I do for my portfolio. And then if the market is really, really good, it's really, really favorable, I'm hitting a lot of my trades, things are going very well, then I will risk up to 20% of my portfolio at a time. This is on rare occasions. This is not normal. This is only during those really, really sure, confident, amazing times in the market that happens maybe once every couple years. And that's when I'll up the risk per trade. The total portfolio risk up to around 20%. And so I wrote this down here. And what this basically says is that with a risk tolerance of 3% per trade, because remember, we put 3% on this trade right here on the bat trade. So it says with a risk tolerance of 3% per trade, you could have 3 trades running at a time. And if the entire market tanks and they all hit their stop losses, then you will endure a 9% loss to your portfolio. You never want to endure more than a 10% hit to your entire portfolio if the market goes against you. So keep the number of trades you take at a time to 3 if you have a 3% risk tolerance per trade. If you only risk 2% per trade, then you could have up to 5 trades to keep your risk to your overall portfolio at 10%. If you risk 1% per trade, then you could have 10 trades running and your total portfolio risk will be 10%. It is good practice to increase your risk for trades that you have more conviction in and to decrease your risk for trades that you are more unsure about or if the market is not favorable. And then down here is what we'll talk about in a minute also, and we also talked about this in the last video as well, but it says if you raise your stop loss on one trade to be above break even, then the risk for that trade goes to 0. If you do that, then you can add another trade and keep your overall risk to your portfolio under 10%. So let's just put in a few more trades here. And we don't really need to go and put the entry price or stop loss, do anything over here. We could just simply put in some imaginary trades. So let's say we are going to put in Engine USD and we will risk 3% for this trade. And then let's say we want to trade Mana and we will risk another 3% for this trade. Right now, the risk per trade is 3% each and our total portfolio risk is 9%. Okay. So let's say that we want to put on another trade. Let's say UOS USD, and the risk for this trade, let's say that we will keep it at 3% because the market is doing really well. So we want to have 3% per trade. Well, now our total portfolio risk is 12%, which is pretty high. If you put this trade on and you only have 1% for the risk for this trade, then your total portfolio risk will be 10%. So if this is basically what this just said. If all of these were 3%, like it just was, then obviously your total portfolio risk is 12. It's over 10. That's not good. So what I did was I put something in here to show you if you are really just like really going overboard. So let's just, say you have another trade for ETH USD and you risk 3% for that trade, and you have another trade Bitcoin USD and you risk another 3% on that trade, and then let's say you go into KDA, right, and you have a 3% risk for that trade. Well, what happened here? Now this just came up. Danger, your overall risk is too high. Why? Because your total portfolio risk is 21%. Okay, remember how I said, like, if everything is like going amazingly well and everything's in line and the market is just popping off and everything is just falling in line, then I will risk up to 20% of my portfolio. But I'm never going to risk more than 20% of my portfolio because you never know what could happen, So over 20% is absolutely insane. as a total risk to your portfolio. Like I mentioned before, most professionals do like 8%, maybe some do 10%. Very, very, very few do more than that. And so I put this in here. So if you actually use this sheet and you put on, position sizes that are too big, or you have stop losses that are too wide, and you eventually start, having so many trades that it puts your entire portfolio at risk for over 20%, then this will populate. And if this populates, then you need to take a step back and you need to de-risk some of your positions in your trading account. Okay, so that is what this does right here. And now that you understand this, I think that we can move on to margin trading and trading with leverage. So before we get started talking about margin trading, here are my thoughts on it. I don't recommend trading with leverage unless you have an extremely solid foundation of how to trade. And even with that, I still do not recommend trading with leverage except for shorting with 1x leverage and also under very specific market conditions. The crypto market moves are volatile. You don't need to leverage trade to win. You could easily make life-changing money without margin trading. And you'll probably lose all of your money margin trading if you don't use proper risk management. However, if you use it correctly, it can make you much more money than if you never use it. And so I'm going to be explaining how I margin trade. Now, this is not how most people margin trade. The way I margin trade involves using it to increase available funds so that I could enter into more trades. I don't margin trade to increase the size of my trades, which is how most people do it. You will understand all of this as we go through this section. First though, let's cover the basics. Okay, so the first thing that we're going to do is we're going to go over an example of how most people margin trade. This is not how I margin trade. This is how most people do it though. So here's an example. Let's say that you have $1,000 in your account. If you put that $1,000 to a long trade and you just simply buy a coin with the $1,000 and the price moves up 10%, then you make 10% of your $1,000 or $100, right? Now let's say that you decide to margin trade. So what you do is you borrow $9,000 and you put a $10,000 trade on into a long trade. If the price moves up 10%, you now make 10% of $10,000, which is $1,000 minus some fees. This is 10 times what you made on the non-leveraged or spot trade. In this case, you leveraged your $1,000 and put on a 10x margin trade. The $1,000 in your account was the collateral that you put up. In this example, the price moved up like how you wanted it to and you made money. That's great, but what if the trade went against you? Well, let's first use the example of a spot position. So if you are in a non-leveraged or spot trade and you put $1,000 into a coin, whatever percentage drop that coin has is the percentage that you are losing. So in this example, using $1,000 as the position size, if the coin drops 5%, you lose $50 because you lose 5% of your $1,000. If the coin drops 10%, you lose $100. If the coin drops 20%, you lose $200. Makes sense. So now let's say that you decide to put on a trade using 10x leverage. In this case, you put $10,000 into a long trade, and because you are using 10x leverage, the percentage gains and losses 10x as well. If the price moves 5% against you while using 10x leverage, you don't just lose 5% like you would in a spot position, but rather 50%. If you lose 100% of your trade, your position gets liquidated and you lose all of your money. In this example, if the price moves too far away from your entry, the exchange will take your $1,000 and you will be left with nothing. Now, if every 5% loss on a trade using 10x leverage is actually 50%, then that means that you will lose 100% if the price moves 10% away from your entry. So here's a sheet that I put together that goes over the margin required based on the amount of leverage that you use. So if you use 1x leverage, that's the equivalent of just using a regular spot trade, just doing a regular spot trade. So for example, if you have $1,000 in your account and you use 1x leverage, you need $1,000 in order to put the $1,000 trade on. And if you use 2x leverage, then the margin required is 50%, which means that if you use 2x leverage and you have $1,000 in your account, you can put up to $2,000, 2x, into a trade. However, if the trade goes against you 50%, then you will be liquidated. Your entire account will be liquidated. So if you have $1,000 in your account and you put on a $2,000 trade because you're using 2x leverage, then that means that you need 50% of the $2,000, which is $1,000, which is what you have. And if the trade goes south or if the trade goes against you by 50%, then you will lose the $1,000 in your portfolio. If you use 4x leverage, you need 25% of the total amount that you're putting into the trade. So if you have $1,000, you could put $4,000 into a trade. However, if the trade goes against you by 25%, your entire account will be liquidated. If you put on a trade using 10x leverage, then if that trade goes against you by just 10%, you will lose your entire account. If you use 20x leverage, then the trade only needs to move 5% away from your entry in order for you to lose your entire account. This is why leverage is so dangerous. And this is also why I mentioned, and I continue to mention, that the way normal people or the average person uses leverage is not how you should be doing it, because it does not fall under proper risk management. You should not be putting on trades that are bigger than your account by using leverage, just by cranking the leverage up and saying, oh, I have $1,000 in my account, so I'm going to put, a $5,000, trade on and use 5x leverage. No, that's not the way to use leverage. Crypto has double-digit swings all of the time. This is why I don't recommend margin trading like how most people do it. Liquidation is a huge risk when it comes to margin trading. Even if you only choose 5x leverage, you will lose 100% of your portfolio if the price of the asset moves just 20% away from your entry. This is not uncommon in crypto. There are thousands of horror stories of people losing everything because they decided to leverage trade. Now, you could keep track of the percentage the market needs to move against your position to be liquidated by using this formula. Liquidation percentage equals 100 divided by leverage. So for instance, if you use 5x leverage, your position will be liquidated if the price of an asset moves 20% against your position, because 100 divided by 5 equals 20. In the examples above, I used $1,000 as your portfolio balance and used 10x leverage on the entire portfolio and went all in on the margin trades. In case you aren't aware, this is not trading, this is gambling. A real trader would never bet his entire portfolio on one position, not in spot or in a margin trade. If you're using proper risk management and only risking 3% per trade, how in your right mind would you be able to risk 10x your entire portfolio on a single trade? If the stop loss was 3% away, you would be able to bet your entire portfolio on the trade and it would still fall under proper risk management. But if you double the amount that you put into a trade by using 2x leverage and you go all in, that means a 3% drop would create a 6% loss on your entire portfolio. And since that is outside of normal risk management, that right there would be the invalidation to put on the trade. So just to make this even more clear for you, let's use a real example right here. Let's look at Kava Tether, and let's say that you want to put this trade on. Okay, this trade has a 3% stop loss. So the stop loss is 3% away from your entry. So if you have, let's say, $10,000 in your account, you could put $10,000, you could put your entire portfolio into this trade, and technically it would still fall under proper risk management, because if you lose this trade, you will lose 3% of your entire account. And remember, your risk per trade should be between 1 and 3%. Obviously, ideally, you wouldn't want to put your entire portfolio into any one trade, but technically, let's just say that that's the case, right? And so you put $10,000, your entire portfolio, into this trade, you lose it, and you will lose 3% of $10,000, right? However, let's say that you use margin like how most people use it and use it incorrectly. And instead of putting $10,000 on this trade, you double it and you put $20,000 onto this trade. Well, now, if you lose this trade, you're not going to lose 3% of your account. You're going to lose 6% of your account. And that's because you're not betting 100% of your account balance. You're betting 200% of your account balance. So you doubled the amount that you're putting into this trade. And you don't have that. You don't have it. So you shouldn't be putting this in, because if you do that, then that means that you're going to be putting 6% risk on your total portfolio, or 6% risk on this actual trade. And you want to keep your risk per trade between 1 and 3%. So knowing that, you now know that you should never put on more than your entire portfolio into any one trade, unless under very certain circumstances, which I'm about to teach you. Because if you put on more than your entire portfolio and your stop loss is more than 3% away, then that particular trade will have a risk that is over 3%. And that is something that you do not want to do. That would by default mean that it is not falling within proper risk management. And so now you know how to not use leverage. And it's funny because that's how everyone uses leverage. It's literally the way to not use it is how everyone does it. So now you know to not do it that way. And we will go into properly using leverage in a moment. First, though, you just need to know the difference between cross and isolated margin. So there are two types of margin, cross and isolated. With cross margin, your entire available balance will be used to avoid liquidation. If you get liquidated when using cross margin, you will lose 100% of your portfolio balance and be left with nothing. Isolated margin equals fixed margin for a particular position, and this could be amended. So if you get liquidated when using isolated margin, only the balance used to open that position will be lost. You can always add more funds to isolated margin positions. Basically, when you use cross margin, you're using your entire account as collateral. And when you're using isolated margin, what you do is you take a portion of your account, you put it into an isolated sub account, and then you trade with margin using that sub account to make sure that your entire balance won't get wiped out if there's a liquidation event. Personally, I don't use isolated, I only use cross, but a lot of people use isolated and then they change it to cross once their once their trade goes in the green and is doing very well. There's a lot of different strategies to this. I'm just going to show you what I personally do. The real thing that you need to understand, though, is this. Using leverage does not affect your position size. Let me repeat that again. Using leverage does not affect your position size. And you're probably thinking, well, what are you talking about? If I have $1,000 and I use 2x leverage, then I'm going to be putting on $2,000. Or if I use if I have $1,000 and I use 10x leverage, then I'm going to be putting on a trade for $10,000. No, that's not the way it works. People totally get this wrong. Your leverage, it doesn't matter if you use 2x leverage, 5x leverage, or 50x leverage. Your position size is not affected by this because margin is not in the position size equation. Remember, we went over that position size formula multiple times. Position size equals portfolio times risk per trade divided by stop loss. Where in that equation is leverage? It's not. The leverage that you put onto a trade should not affect your position size for that particular trade. Okay, so let's say that you wanted to take this trade and your account has $100,000 in it and you want to risk 3% of your portfolio. So your risk for this trade is 3%. Well, your position size is your portfolio times risk per trade divided by stop loss. Your position size equals $100,000, which is your portfolio, times 0.03, which is your risk per trade, divided by 0.07, because that is the stop loss for this trade. It's 7%. And that equals a position size of $42,857.14. If this trade goes against you, you will lose 3% of your $100,000 portfolio if you get stopped out at the stop loss that you set. It doesn't matter if you don't use leverage and 100% of the $42,857.14 that goes into this trade is yours, or if only 1/5 of that position size is actually your money and the rest is borrowed with 5x leverage, or if 1/25 of the position is actually your money and it's set at 25x leverage. It doesn't matter. If you lose this trade and you put in $42,857.14, you will lose $3,000 if it hits your stop loss. You could put in $4,285.70 of your own money into this trade with a position size of $42,857 and borrow the rest using just over 10x leverage. Or you could put in $21,428, which is about half of the position of your own money into this trade and use 2x leverage. If the trade hits your stop, you will lose the same amount of money no matter what. And if the trade hits your take profit target, you will win the same amount of money too. So the only thing leverage changes is how much money in the trade is your money compared to how much money in the trade is borrowed money. So then, what is the point of leverage? Well, let's go back into our previous example where you put in 4 trades and used up all of your capital. So in the first risk management video, we had an example where we started out with $107,540 and we put on 3 trades, Engine, Kava, and UOS, with the following amounts going into each trade. For Engine, we put $23,011. For Kava, we put in $26,729. And for UOS, we put in $19,318. Adding them together, you would get $69,058 in active orders, with $38,482 on the sidelines. The risk for these trades was 3% each, or $3,226 each. So that means that there was a total risk of 9%. And that also means that if all 3 of those trades actually hit their stop losses, then you would lose 3% for each of those trades, and that's why you would lose 9% of your portfolio. And then what we ended up doing was we ended up raising the stop loss for the ENJ trade to above break even, and that reduced the risk for that trade to 0%, and it also reduced the total portfolio risk down from 9% to 6% because we took the 3% risk that was on the ENJ trade. And when that was reduced to 0, that also reduced our total portfolio risk. Then what happened is we saw a new trade set up for MLN that would allow us to put on $49,633 into that trade and risk 3% for that particular trade, bringing our total portfolio risk back up to 9%, which was within our risk tolerance. But we only had $38,482 available because the rest was being used in our trades. Well, in video 1, we simply put the $38,482 that we had available into the MLN trade and we just let it be. However, you could have put in the $49,633 that you calculated to be the correct position size by using 2x leverage with the remaining $38,482 that you had left in your account. By doing this, you would only need to put up 1/2 of the position's value as margin into the trade. And this would allow you to trade the full amount and retain a 9% total risk to your portfolio. And that's how you could use leverage or margin trading to actually put on position sizes that are the correct position sizes for your particular risk tolerance, and yet still not go overboard and not put on too much risk. Alternatively, you could use margin to free up the capital you put into your ENJ trade, because even if it hits your stop loss at this point, you won't lose any money. So you could change your ENJ trade from using 1x leverage to really using any leverage you want. So in this example, we'll say we're using 20x leverage, and you change it to 20x leverage, which would free up 4/5 of the original $23,100 that you put into the trade. And that equates to and frees up $18,408.80. Because when you crank the leverage up on the trade, so let's say you crank the leverage up on your engine trade to 20x, what it does, it just means that the margin that you're putting into the trade gets lowered. So originally you put in the $23,011, you put that whole thing into the trade. But once you crank the leverage up, the margin that you have in the trade is going to be related to the leverage that you use. So for 1x leverage, you're putting in the entire position as your capital. Like all of the margin for the position is your capital. But if you use 2x leverage, then you only require to put in 50% of the actual capital in the trade as margin. And so you could raise it up to 10x leverage, and then you're only required to put in 10% of the capital of the trade. So in this example, we took the engine trade that we raised the stop to above break even, and we lowered the risk for that trade down to 0. Then what we did was we took the leverage for that trade and we cranked it up to 20x, which freed up $18,408.80. And then we used $11,151 of that money in the MLN trade, and we put in the full amount of $49,633, which let us still be within our risk tolerance. So you could do it this way, or you could do it how we did it in the last slide, where we simply put 2x leverage into the MLN trade. Now, imagine that the entire market is booming, right? And you raise your stops up on all of your active trades. Now you could change the leverage on them and free up significant capital and can utilize your new funds in more trades without overextending your risk. catching more coins and their upward moves as the market brings everything higher. You could see that this can be extremely powerful if done right. However, this method of turning your winning trades into leverage trades after you raise your stop losses to break even or above is the only way I would recommend using leverage. And this only happens in bull markets, which only happen maybe once or twice a year, depending on a whole bunch of circumstances. And they only last a certain amount of time before they're over and the opportunity is lost. And when it is lost, there's usually a huge crash that ends up liquidating a lot of people. So you have to be super careful with this. And this is why I hardly even talk about leverage, because it could really mess a lot of people up unless they utilize it properly, which is what I'm talking about in this video. And the method that I'm talking about, it works best when you get in at the bottom before a huge rally, because that way the rally will start and the prices will rise significantly. And then you could simply just raise your stop losses and then you could put the money into other trades. And the thing is, you really should have the wherewithal and a deep understanding of market cycles and where we are before venturing into this type of trading. I do talk about market cycles a lot in this course and in my videos, and you really should have that understanding. Otherwise, I don't want you to get wrecked. And there are a lot of people who would have just been much better off spot trading or simply just averaging into Bitcoin and Ethereum or maybe some other coins and just playing that game and not leverage trading and not touching margin or leverage trading. But I'm teaching you right here, this is one method that you could use that remains relatively risk-free. However, of course, this is crypto market. If there's a flash crash or something, you could still get liquidated. There's a lot of caution that should be taken. But this is how I do it. Okay, so let's go over a few more examples so that things get a little more clear, because that is what this is all about. So let's say, for example, you have $10,000 in your account and you want to put this trade on because you see that rose, it had this huge spike up and then it started to come down. So you think, okay, I saw this support, this diagonal support continually get hit over and over and over and over and over and over and over again. So I want to put on a trade right here. I'll get in right here. My stop loss will be right here because it'll be underneath these wicks. And my take profit, since we're in a bull run, will be literally at the very top of where all of these wicks were. So this is what you do. So first things first, go into the position sizing calculator and input the entry and the stop and the take profit to make sure you know how much you're going to put into this trade. So the entry is 0.22218. Stop loss is 0.18838, and the take profit is 0.44078. So putting all of that information into the Crypto Elite position sizing calculator, we get a position size of $1,972 if we are risking 3% on this trade. So we could put this on and say that this is Rose USDT. And we are risking 3% on this trade. So then let's say that you go back into the charts and you see another great trade setup, and this time for Link. And you were looking at the charts and you saw that Link had this humongous run up like this, and it starts to come back down. And you saw that there was major diagonal support, basically the same thing that was happening with Rose. So you want to get in at this major diag support down here. And so you put this trade on where your entry is 13.38, your stop loss is 12.38, and your take profit is at 34.04. And for this one, because you're so confident in it, you're going to risk 5% of your portfolio into this trade. So let's put those numbers into the position sizing calculator. So looking at the position sizing calculator, you put 13.38 as the entry price, 12.38 as the stop loss, and 34.04 as the target price. You're risking 5% of your portfolio on this trade because you're just going, you're going all out on this one. So this position size is $6,690. So you're going to put Link and USD or USDT right there, and you're going to put risk per trade, 5% into this trade right here. And this is going to be the second trade. And now let's say that you are looking for a new trade. So let's say that you start looking at Doge and you realize that, well, it hit here once and then it came down and hit here again. So if it comes back down to this area, you're going to get in and you're going to try to take your profit for over 100% right up here in this resistance. And your stop loss for this trade will be only 6.72. So it's a great RR, just like all the other ones. And your entry is 0.1647. Your stop loss is 0.1536. And your take profit is 0.3329. So let's put those into the position sizing calculator. Okay, so in the position sizing calculator, you put the entry price, you put the stop loss price, and you put the target price, and you got the recommended position size of $4,491. That's great. However, you can't put $4,491 into this trade because you don't have that much because of what you put into rows and what you put into link. You don't have this much left over. However, you could see that for our Doge trade, we only wanted to risk 3% of our portfolio. So if you put Doge USDT and then you put 3%, that means that we have a total portfolio risk of 11%. And let's say that the markets are going absolutely crazy and you are okay with risking 11%. So in this situation, you only have $1,338 available to put into your trade. However, this trade is $4,491. So obviously this trade is too much. So there's a lot of different things that you could do. You could try lowering your portfolio risk for this particular trade to see if it falls under how much you have available. And if you do that, then you get $1,497, which still isn't enough to cover it. But why would you want to do that if the markets are booming? Why not keep it at 3% risk and keep this? So to keep this recommended position size the way that it is, and to make sure that your risk per trades remain what you desired them to be, and that your total portfolio risk remains at 11%, what you could do is you can put a leverage position into this trade. So, or make this trade a margin trade or a leverage trade, and you could put the leverage up to where it will make sure that your margin that you put into the trade, the capital that you put into this trade, is what you have available. So in this case, you need this number to turn into $1,338. So if we turn the margin up to 2, that's still not enough. However, if we turn it up to 4, you'll see that we could put this trade on with 4x leverage with the original position size that we had, because we will only be required to put $1,123 of our own money into this trade. And that way, everything can remain the same of how we want it, except we'll put this much money of our own capital into the trade. Now, the thing that you absolutely, without a doubt, have to understand is that if you do this, you're allowed to put 4x leverage on this trade because of where the stop loss is on this trade. So going back here, you could see that the stop loss is 6.72%. And then coming back here, you will see that for 4x leverage, the margin required is 25%. So if the price drops 25%, your position will be liquidated. However, our stop loss was at 6.7%. So we could use 4x leverage because our stop loss is much way below this 25% margin required area where we will lose it all. We will get out of our trade well before it hits 25% if we use 4x leverage. In fact, because it is under 10%, we could use 10% leverage on this particular trade also. And that way, we will still get out at 6.7%, what the stop loss is. And it doesn't matter that we're using the leverage because we're putting $4,491 into the trade regardless. And so let's say you use 4x leverage, $1,123 of that trade will be your money and your capital, which means that you have enough to be able to put into that trade at 4x leverage, and then you won't have enough to really put into any other trade because you won't really have that much money left. So that's one way that you could do it if you are comfortable with having your portfolio risk be 11%. Or you could do it like how we did it beforehand. If you want your portfolio risk to remain under 10%, then this is just too much, right? The 11% is way too much. So if you want your portfolio risk to remain under 10%, then what you could do, other than simply, lowering your risk per trade for Link, for example, is you could wait until Rose or Link hits their entry and then starts moving up. And then you could put on this leveraged trade for the correct position size for the $4,491. And your risk per trade will remain under whatever you wanted it to be. So let's say, 9%. So let's say that the Link trade happens and starts playing out. Let's see what happens in that scenario. So here's the Link trade again. And let's just say that the bars started playing out and then the price dropped and boom, it hit your, actually right on the money, hit your entry and then started moving up. And by this point, it's up all the way 75%. So you could easily raise your stop, not just to break even, but you could raise your stop, all the way up here if you wanted to. And then that way, this trade is no longer at risk. So let's say that this happened, and then you go back into your position sizing calculator and you take the risk off of your Link trade. So you go back here and you put your risk for this trade at 0. Boom. Well, now your total portfolio risk is 6%, which means that you can put the Doge trade on just like how you did it before and, use 4x leverage, and it doesn't matter because your total portfolio risk is at 6% because you raised your stop loss for the Link trade to above break even, and now the trade for that is 0. And the other thing that you could do in this situation, if this is what you did, is you could then raise the leverage for your Link trade from 1x to literally whatever you want, because your risk for that trade is now 0. And then that lowers the amount of margin that you have in the trade itself and frees that capital up so that you could put it into new trades. So then if you do that, then you could have enough money to put 1x leverage on this Doge trade and to use the Doge trade with simply 1x leverage. Or you could still put 2x leverage on the Doge trade and then put on another trade and then put on another trade. As long as your total portfolio risk remains under 10%, it's pretty much good if you do this. So there are a lot of different methods to this. So like I said, you could wait until the Link moves up and then raise your stop loss so that your risk for this trade goes to 0. And then you could raise the leverage on your Link trade, which frees up capital. And then you could just put the Doge trade on like normal. Or you could use leverage on the Doge trade to only put in the amount of capital that you need to put in, the amount of margin that you need to put in for this particular trade so that you could actually put the trade on. There's a lot of different ways to do it, or you could just lower the risk per trade for all of the trades so that it frees up more capital. But this is how I do margin trading. So this works both longs and shorts. And so I'll just show you one other, the only other thing, which is short trading now. And so here's an example of a short trade that I actually put on in real life. So I noticed the Link chart, just like I showed you before, there was this major diagonal support, right? It kept on bouncing on the support here, 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 and then here and here and here. Well, not too long ago when I'm recording this video, it ended up crashing down below that support. And then I thought to myself, wow, this support was really, really big. So I'm going to put on a short position, and I'm going to put a short position on something, something like this. And I'm gonna do this. So this, you have to use leverage in shorts. So this is the other reason why I'm talking about leverage, is because literally you have to use leverage in short positions. But it's the same exact way as a long position. Okay, you don't crank up the leverage and then put on more than your position size if you're doing a short. You simply just use 1x leverage in the short position if you want to do this. So in this case, let's say, for example, 18.61 would be your entry, your stop loss would be 20.90, and your take profit would be 13.33. So let's put that into the calculator. So we put those numbers into the calculator, and then we make sure that this position is on short because it's a short position, and that gives us the recommended position size of $2,437.99. So $2,438, right? And so I would put on a short position with this amount of money if I had a $10,000 account and I am risking 3% on this particular trade. And it would be the same exact way. I would just use 1x leverage and do this. And then let's say I put on another short position and then another short position and I ran out of capital, but I'm still under my total portfolio risk. Then I could use leverage to put on another trade. And as long as I'm still remaining under my total portfolio risk, this is the most important thing that you have to know, is you have to remain under your total portfolio risk. As long as you're still doing that, then it's good. And that's how I do it. And so I could do it like that. Or if, for instance, this trade starts actually happening and the price comes back up, hits my entry for my short position, and then starts coming back down, which it did. And then let's say I lower my stop loss, I lower my stop loss to like right here, for instance, then I have 0% risk on this trade. So if I do that, then I go back into my calculator and I'll just do the same thing that I did in the long position. And it's the same exact situation for shorts. So that is how I margin trade. I'm not saying do this. I'm just saying this is how I do it so that I stay within my risk that I put for myself and I don't risk more than what I determined before I even put the trade on. And so in summary, margin trading is for serious traders only. Always determine your position size using 1x leverage before you put the trade on. The amount of leverage you use only changes how much margin you put into the trade, and never abuse the power of leverage. Trust me, if you start abusing the power of leverage, there is a very, very high likelihood that your account will be wiped out and you'll end up losing way more money. So I have this video in here as a cautionary tale. So some considerations: while raising your stop does eliminate the risk in the trade, it also opens you up to being stopped out more easily. The price loves to come back and retest support once or twice after it jumps up. So be sure that if you are raising your stops, you are doing it in a calculated fashion, or else you'll probably end up just getting stopped out of your trades early and missing out on your gains. And if that happens, you would have been better off simply trading spot or never moving your stops at all. So with knowing that, that's the risk management video number 2, part 2. Hope you enjoyed it. And now you know some advanced strategies and some very cool tips and tricks on how I trade and how I can increase my position sizes without really upping the risk that I pose to my account.